BlackBerry is on the block, Wall Street analysts are being naughty again, and we're going to talk fantasy football because we can. You're in the right place because this is where the money is. All right, well, normally I am joined by both David Hansen and Matt Koppenheffer, but today, just Matt, which is fine.
David is playing golf today. I guess every once in a while he deserves a day off. He does most of the work between the two of us anyway, so I'm happy to let him have a golf outing.
Is he really? He's really playing golf today?
It's a charity golf event.
Right.
So.
Aww.
Yeah, exactly.
We'll have to find out how he did.
Exactly.
All right. So, well, enough of that. Let's get to the headlines. First up, over the Wall Street Journal. This is big news today. BlackBerry is exploring putting themselves up for sale, and they're not the only ones, though. So we kind of wanted you to give a kind of look at what is going on the M&A front right now.
Yeah, so what we're gonna hear plenty about BlackBerry from every different angle. So I thought I'd look at one that probably not a lot of people are looking at, and that's just generally the M&A angle. So we've got BlackBerry here exploring strategic alternatives, which could mean it going private, could mean it potentially getting bought out by a strategic, so another larger company. But we've also got a lot of other activity going on. We've got Dole agreed to be bought out, taken private by its CEO for $1.2 billion. We've got Steinway Musical Instruments now in a bidding war between some unnamed bidder, mysterious bidder, and KKR. And we had Rockwell Collins. This was yesterday. Rockwell Collins agreeing to buy Arink from Carlyle, and that's a $1.39 billion deal. So there are two things here that jump out at me. Number one is the economic angle. When companies and CEOs, there are a couple going private transactions here, potential going private transactions, are ready to throw around $1 billion here and $1 billion there to buy a company, it means people are feeling pretty good about prospects of what's going to happen. So that's a good thing. I think we can feel good about that. The other thing is, this is a financial show. We think about banks and financial companies. So this is the M&A angle. When we think about Goldman Sachs, global leader in M&A, typically JPMorgan, typically fairly close behind them.
And brought in on the BlackBerry.
Exactly. JPMorgan is the advisor on the BlackBerry deal. Over with the Dole deal, we've got Lazard working on that. Allen and Company on the Steinway deal. And then the Rockwell Collins deal, you've got Citigroup advising Rockwell, and then Carlyle and Arink were advised by Evercore and JPMorgan again. So looking forward, looking at all of this activity, and this is just in the course of a day or so. Granted, M&A activity often takes place over the weekend. These deals kind of formalize over the weekend. That's why it's so great to be an M&A banker, because you're working on this stuff all weekend. But you hear a lot of deals announced on Mondays. But nevertheless, I think this is a good sign for the M&A market. So that's a good thing for bank investors.
Right. All right, next up, we've got from Reuters. Now, last week we talked about how banks were warehousing metals, and they were messing with big soda because the price of aluminum was going up, and companies like Coca-Cola did not like it. So today we learned just how much you don't want to mess with big soda, because there are subpoenas coming out by the CFTC,
right,
is issuing subpoenas to look into metal warehousing. So is this something we should be keeping an eye on? Is this something or nothing here?
Well, there are also individual suits against Goldman Sachs and JPMorgan and Glencore. So this is becoming a bigger thing. In terms of it, whether it's something or nothing, I'm gonna hold off. My inclination is to say that it's nothing, to say that this was an arbitrage opportunity that the banks went after, and it was an opportunity for them to make money. This is what they do. They find arbitrage opportunities. They use the capital that they have as banks, as investment banks, in Glencore's case, as a commodity specialist. And they make money exploiting those arbitrage opportunities. And in some cases, it doesn't tend to work out for the rest of the market, and so rules change, regulations change, and the arbitrage opportunity disappears. So I'm thinking that that's what's going on here, that there was an arbitrage opportunity, it's not working out for the market, and now rules and regulations are going to change and it's going to go away. However, perhaps there were underhanded things going on, and the banks were skirting pre-existing rules as they were doing this, and it will come out that there's reason for lawsuits, that there's reason for the regulators to go after them. So I think we got to just wait and see what comes out in terms of the actual evidence. But for now, I'm thinking that I'm leaning towards the nothing, but I'm waiting.
All right. So our final headline is, this comes to us from New York Times Deal Book. With IPOs on the rise, analysts get new scrutiny. So earlier you mentioned how the increase in M&A is a good sign for the economy. Also, IPOs is generally, when you see more, that means we're a healthier economy. But the downside is that analysts are maybe being a little naughty and talking to companies about things they shouldn't. So why should analysts not talk to companies about IPOs?
This is just so stupid. And the reason that they should not be talking to companies is that the analysts are looked at providing objective analysis on the companies that they are analyzing. And back in 2000, there were all the shenanigans that went on where basically you had research analysts pitching companies, you should have our bank do your IPO, which can mean millions of dollars for the investment bank. You should have our bank do your IPO because I love your company, and when my research comes out, it's going to say you're a buy no matter what. And for obvious reasons, companies love this. And that all ended with a thud, to say the least. And now there are rules in place that create what they call a Chinese wall between investment banking and research. And so investment bankers are not supposed to interact with research analysts, and research analysts are not supposed to be involved in the pitching of companies for IPOs. Now, based on what the banks are saying, they're trying to claim that this is not a case of research analysts actually pitching companies on the IPOs, that they're just sort of guiding on how they see the overall industry and trends and that sort of thing. There's no room for gray area here. The analysts this shouldn't be happening. If a company is on the IPO track thinking about IPO, banks should just keep their analysts away from them and just avoid this kind of scrutiny.
All right, so that covers it for the headlines today. Now it's time to go for our deep dive. Now, as promised, we're going to talk about fantasy football. It is football season. The best thing about football season, of course, fantasy football.
Oh, yeah.
And as you were explaining to me, thinking about fantasy football and how it is affected, I always say that, affected your investment strategy.
It's also infected my
It's infected and affected your thinking on investing here.
So I will admit right up front that last year was the first year that I played fantasy football. But I found a lot of what I was doing very interesting in terms of the tie-ins to investing. And so here are a few of the takeaways from my last year of playing fantasy football and looking ahead to this year playing fantasy football. Off the top, it's difficult to find big opportunities with big name players. So if you think about Aaron Rodgers, Calvin Johnson, Arian Foster, these are franchise players, and everybody recognizes that. So they're going to go in the first round. They're going to go towards the top of the first round, and you're probably not going to have an opportunity to, see Aaron Rodgers fall to the second or third round and say, "Oh my gosh, I can get Aaron." The same holds true for a lot of stocks. In terms of the really big, well-known, very successful companies, often they will be valued as such. Berkshire Hathaway is a good example. We're always talking about Berkshire Hathaway here. So how could you smile, but how could we not have a show where we don't talk about Berkshire? It's interesting that over the past few years that might have been violated. There might have been an interesting opportunity to buy Berkshire at a very attractive valuation, but typically everybody recognizes you've got a great collection of businesses. You've got a CEO that's I think second to none in Warren Buffett, and so you're not going to find too many opportunities to let's say draft Berkshire Hathaway in the second round, right? And the same goes for other quality companies. I mean, if we look to other industries, look at Netflix. I mean, I was looking at Netflix the other day. I finished watching Orange is the New Black. And I had watched Arrested Development, and I had watched House of Cards, and I'm thinking to myself, oh my gosh, the content creation with Netflix it's a whole new chapter, a whole new page. And so I immediately took out my computer, looked up the stock, and I was like, maybe I should think about buying Netflix. And I looked at the valuation, and it's kind of like, well, everybody else is looking at the same thing, and they valued it as such. So, top players, big franchise players, probably not going to be, it's going to be tough to find value. Second thing, though, is that you can find value sometimes in those big name franchise players. And this is often a situation where there's been an injury or something's going on, and people aren't expecting that they will come back out and have the kind of performance that they have in the past. Great example of this from last season was Adrian Peterson. Adrian Peterson was coming off a torn ACL, which is it's a significant injury, and particularly for a running back. And here's what a Sports Illustrated writer wrote at the beginning of last season's fantasy season about the prospect of drafting Adrian Peterson for fantasy football. He said it's a risk factor of 10. Drafting Adrian Peterson is like if you found some raw oysters at the bottom of a dumpster in Tijuana covered in SARS sauce. So in other words, saying, don't do it. He's too much of a risk. And what ended up happening? Well, Adrian Peterson ended up finishing the season with 2,097 yards, number one in the entire NFL, and 12 touchdowns, which was tied for third in the NFL. So you've got this great player. There's a cloud over what he might be able to do. And so there were people that were able to pick up Adrian Peterson late in the second round and on into the third round last season. In a similar fashion, I'd say look at AIG. That's a good example of this. Talk about a huge injury during the financial crisis. I mean, it's as if AIG tore its ACL and then got shot in its other leg with a bazooka. I mean, this was in need of a huge comeback. But you've got Robert Benmosche, who's the CEO there now. I think he's done a great job sort of rebuilding the company, refocusing. And I think now, based on the valuation, you have a good opportunity to pick up what was, and I think could still be, a stalwart of a company at a non-stalwart price. So you have that rare opportunity to get a really great company, we'll say low in the draft order. And finally, number 3, making good picks up front is important. But at the same time, I found that throughout the fantasy season, it's very important to manage and keep tabs with what's going on and be flexible as things change, as people get injured or others, like Adrian Peterson last year, living up to more than people were expecting, other players not quite living up to what people were expecting. It's the same with your investment portfolio. You've got to be flexible. You've got to be willing to say, here's what I thought was going to happen with this company. Here's what I thought were going to be able to do. Here's what I thought leadership was going to be able to deliver. But be able to admit sometimes that it doesn't work out in every situation. And be able to say, I had hopes for this, didn't work out, maybe it's time to sell, or maybe it's time to cut back my position until they prove that they really are delivering on what I thought they would. And just having your eye on other overlooked players that you don't have in your portfolio, stocks that you don't have in your portfolio, that might be good to bring in and draft late in the season, bring up from the minor leagues, as you might say. Now I'm mixing metaphors.
That's fine. You can mix your sports.
Kind of weird.
That's fine.
But like I said, that was my first fantasy season, so I'm still on the mixing metaphors. So again, fantasy football is fun. It's a great way to enjoy the football season. But I found from playing it for the first time last year that there are a lot of parallels to investing, and I think I learned a lot, and it helped my investing.
So, and that's why later this week on Thursday,
it'll be a big day on Thursday.
Big day on Thursday. Big day. We are going to have the first ever Motley Fool draft.
Yes. So,
for everyone to watch.
Right. So what we're going to do is we're going to take all of the financial companies from the Russell 3000. There are about, I think, 500 or 700 financial companies in the Russell 3000. And we're going to have 3 or 4 analysts in here. And we're going to go round robin. minute on the clock for each analyst, and they'll get to pick what their favorite financial stocks are in fantasy football draft style. So it's going to be a lot of fun.
All right, so Thursday, keep an eye out for that. But in the meantime, though, you want to give us a draft preview of who you're looking at for insurance.
Yes.
Right, in the insurance sector. All right, so specifically, I kind of want to know, what are your franchise players here that you're looking at?
Okay, and I should point out, I'm going to look at insurance today, one of the big sectors in financials. Later this week, I think on Wednesday, we're going to do a draft preview for the banks, so that's another thing to look forward to. Now my stalwarts, of course, Berkshire Hathaway. Right?
I'm sorry, I should have just said, after Berkshire Hathaway, who are your franchise players?
You should have guessed that one. But Berkshire Hathaway, I won't go into any more detail on that. Let's just leave it there. Travelers companies. The leadership at this company, Jay Fishman is the CEO at Travelers. I think it's just it's not a very exciting company, but it's a well-run operation. It's a conservative operation. They write good policies, and they've performed well over time, and that's about what you can hope for and expect from a good insurer. Aflac is another I'd put up there in terms of my stalwarts. Everybody knows this for the duck. What they may not know it for is, so I'm looking here at the last 12 months, a return on equity of 24%. This is a high caliber insurer in terms of being an insurer you can count on if you're a customer, but I think it's definitely a high caliber insurer to count on if you are an investor as well. None of these are particularly great values right now. I'm looking at Travelers trading at a price to book value of 1.2 times, so that's the cheapest. That actually seems like a pretty decent valuation to me. 1.4 times book for Berkshire Hathaway. It's a little bit higher, but again, Berkshire Hathaway.
And your boy.
Yep. And Aflac trading at over 2 times book. But when you're talking about a 20+% return on equity, you can pay a little bit more and still find a decent return on it.
So do you have any Adrian Petersons in there in the mix? So who are your value plays?
Oh, you bet. So
a couple.
Yes. So AIG is at the top of that list. That's trading at less than 3/4 of its book value. And this is across the board in the life insurance sector in particular right now. Valuations are pretty low, and part of that has to do with the fact that interest rates are so low. It's a lot harder to sell some life insurance and certain types of retirement products. A lot of these life insurance companies do life insurance and retirement products, and when interest rates are low, that impacts the spreads that they can earn on their products. And also, it just makes the sales atmosphere is more difficult in terms of selling these policies to customers because the returns aren't great. So valuations are low in general among life insurers. AIG has a big life insurance operation, a retirement products operation. But at 3/4 of book value, thinking about the quality that I think AIG will deliver over the next 5 years, next 10 years, I think that's a great one that's potentially overlooked. Genworth Financial, in terms of being looked at as kind of injured and banged up and could there be a potential for a comeback, this stock is trading at less than half of book value, so there's a lot of opportunity there if Genworth is able to turn it around. But in terms of writing insurance on homes, on mortgages, during the financial crisis and trying to recover from that, and then also having a life insurance and retirement products, there's some risk there. But you've got a great valuation. And then one other that I'll point out, Endurance Specialty Holdings. This is a little known insurer, but the last time that I looked at it, and again this was a few years back, I thought that this was a quality insurer. Again, sort of like Travelers, boring but gets the job done. I don't know what's going on right now specifically that's driving this valuation, but I just noticed this morning that this is trading at about 0.85 times book value. So that to me is a pretty nice valuation, assuming that something big hasn't changed at Endurance in terms of how the company operates.
So if you had to pick one dark horse, I don't know if you want to give it up here before the actual draft, but if you had to pick one dark horse, who would it be?
Oh, one dark horse. Here's what I'll do instead. I will give three that I think are. Man, there are so many on this list that I think could be good picks. I'm just, instead of giving one dark horse, I'm going to throw out a few other picks that I think should definitely not be overlooked during this draft. One of them, of course, is Markel, often known as Baby Berkshire. I can't say enough about this operation. I think they are run so well. Tom Gaynor is the CIO there. He's done a tremendous job investing the assets at Markel, and they have a sidecar which is called Markel Ventures, which buys entire companies, very similar to what Berkshire Hathaway does. I think that's a great pick. W.R. Berkley, specialty insurer, very well run, very solid, steady operation over time. I'm looking at just about a 12% return on equity over the last 12 months. I think that could be a good pick. And for a final wild card, let's go with Greenlight Capital. Greenlight Capital is a reinsurer. The funds there are invested by David Einhorn and his hedge fund. So that's a really interesting tie-in there for investors who are looking for big upside in terms of a reinsurer investing its assets. The problem is that the reinsurance market hasn't been really great lately. What happens in the insurance market, the overall insurance market in general, is sometimes a lot of capital flows in, and the insurers can't raise prices on their products. And what ends up happening is they can't be as profitable because the profitability of your underwriting depends on being able to raise prices and price appropriately. So when a lot of capital flows in, you get less profitability on the underwriting side. We've seen a bifurcation of the primary insurance market. So primary insurance is like Geico writing auto insurance directly to me or you. Reinsurance is where an insurer insures an insurer against bigger risks like catastrophe risks. The primary insurance market has seen rates start to come back, has seen the market start to harden up. In the reinsurance market, there's been a lot of hedge fund money, there's been a lot of pension fund money flowing into it, and so rates haven't been as good. So Greenlight Capital got the interesting David Einhorn tie-in, but also the challenges that we've seen in pricing in the reinsurance market.
All right, I think that covers it all for your draft preview for Thursday.
It covers
right?
most of it.
I don't know how many other companies you could have crammed in there.
I don't know, but there are a lot of good insurers that could be good picks on Thursday.
All right, so then that's all for the insurance draft preview. We will see you here on Thursday for the actual draft with a few more guys, and it should be a lot of fun.
It'll definitely be a lot of fun.
All right, so now it's off to the Twitters. That's enough. Let's blow through these tweets pretty quickly here, huh? All right, first up, we've got at TMF Housel. This is Morgan Housel. This is a macro writer here at the Motley Fool. Dearly beloved. We eavesdropped on him talking to Eddie Elfenbein, saying, also, earnings don't miss estimates. Estimates miss earnings, which is just the sweetest little thing I read all morning.
It's beautiful. It's beautiful. We take it for granted that every single newspaper headline is so-and-so, such and such company missed earnings estimates. No, they didn't. Companies do what they do. They run the business. They produce what profits they produce. It's analysts' job to try to figure out what's going on and try to estimate what the companies are going to earn. So it's the analysts getting it wrong, not the companies getting it wrong. And this is what Morgan does, is he nails those simple things just like that. I think this is great.
So is there a company this last earnings season that you feel particularly the analysts got it wrong on? Is there one that stands out?
Let's see. In the banking sector, they mostly beat earnings estimates, or you could say the analysts were wrong across the board on a lot of the big banks, because most of the big banks, maybe all four of the biggest banks, topped estimates. So we can say that they got it pretty wrong there.
All right. Next up, we've got Dan Primack, bank analyst, once again helping to win IPO business. Now, I'm pretty sure we already talked about this, Matt. Why do you want to go back to it again?
We did, but I put it in there because it's that important. First of all, in Dan's tweet, I love the subtle question structure of it. Just like, oh, are they really doing this? It's unbelievable that this would be happening. There is so much regulatory scrutiny on banks right now, on the big banks right now. There is no room for them to be there shooting themselves in the foot. And I won't even say if it's something untoward going on. It's all optics here, or they should be thinking in terms of optics. And this is bad optics when you're getting sued for something different every other week or every week. Every week there's another lawsuit coming out. Don't do it. Don't do it. Get Nancy Reagan on the phone. Just say no.
All right. Last one. We've got Ezra Klein over at the Washington Post. Last week we talked about how everyone is hopping aboard the Larry Summers hate train, and we've got a new person hopping aboard, and that is Bette Midler. Ezra tweets, Larry Summers is not the wind beneath Bette Midler's wings. So this is actually very funny. She didn't just tweet once her hatred of Larry Summers. She's got a whole string of them, including, the architect of bank deregulation, which turned straight-laced banks into casinos and bankers into pimps, may be the next head Fed. Summers.
Bankers are pimps, apparently. Well, this is just this.
I had no idea he had so much credit to take for all the corruption.
I will admit that I did not read any further than the tweet, but Ezra Klein's tweet, amazing. Just hilarious, and yeah, like you said, one more to add to the Larry Summers hate train. I think the chances are better that let's say, I don't know, that Detroit is out of bankruptcy and has a free inflow of new residents starting next week, then Larry Summers getting elected to or getting chosen to run the Fed.
So
I think basically zero chance.
So in your Fed Pick'em league, you're not going with Summers.
Yeah, in my Fed Pick'em league, Larry Summers is going undrafted.
Right. All right. Well, I think that covers it for today.
It does. One question for you.
Yeah.
What is the wind beneath your wings?
What is the wind beneath my wings? Well, I just had a baby, so I gotta say
that's
seeing her smile is the wind beneath my wings. You?
Well, I can't go non-sentimental after that. I'm heading to Jacksonville this weekend to see my niece, my only niece, and let's say she's the wind beneath my wings.
Little baby girls.
Yes.
Love them. All right, well, that covers it for today. We will see you again tomorrow, and definitely hope to see you again on Thursday when we have our draft, because this is where the money is.